Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. With the latest read on inflation mixed, showing further disinflation in the headline PCE, but a reversal in the core, pushing to a 3-month high at 2.7%, all eyes shifted to the labor market last week as the next key indicator to determine the appropriate pathway for monetary policy. Ahead of the key jobs report on Friday, an updated release from the JOLT survey, or the Job Openings and Labor Turnover Survey, showed the total number of job openings rose 329,000 to over 8 million in August, the highest level in 3 months, with the ratio of job openings to unemployed persons remaining at 1.1, now below the pre-pandemic average of 1.2. The latest read on jobless claims also showed ongoing resilience in terms of labor market conditions. Claims showed a minimal 6,000 increase to 225,000 in the week ending September 28th, still, however, well within the range established since the start of 2022. Meanwhile, the 4-week average declined from 225 to 224. Continuing claims, or the total number of people claiming ongoing unemployment benefits, was also relatively positive, roughly unchanged at 1.83 million. Also last week, ADP set a relatively high bar for the payrolls report, indicating private sector employment rose by 143,000 in September, well surpassing the 125,000 gain expected and marking the largest increase in 3 months. Before finally coming to that all-important September employment report released at the end of the week, a report worth waiting for. Non-farm payrolls surged 254,000 in September, well surpassing the 150,000 gain expected and marking the largest increase in 6 months. The 3-month average also increased from 140 to 186,000, a 4-month high. August payrolls were also revised up for an additional 17,000 to a gain of 159. Thus, with additional revisions to previous months, the overall change in non-farm payrolls, meaning September data plus net revisions, was 326,000, the largest increase since January of 2023. In the details of the report, private payrolls rose by 223,000, the largest increase since March. Goods producing payrolls increased by 21,000 due to a sizable increase in construction payrolls and despite a slight dip in manufacturing. Services payrolls rose by over 200,000 in September, nearly double the rise in August, thanks to widespread gains in everything from education to health to leisure and hospitality to professional and business services, as well as trade and transportation, financial and information services. Household employment, meanwhile, rose by 430,000 in September, while the labor force increased by a lesser 150. Thus, the participation rate remained unchanged at 62.7%, now for the third consecutive month, while the unemployment rate unexpectedly ticked down from 4.2 to 4.1 in September, a 3-month low. And finally, average hourly earnings rose 0.4 in September, a tenth of a percentage point more than expected, and following an upwardly revised 0.5% increase in August. Year over year, wages rose 4%. That's a gain from a 3.9% increase in August, and marking now the largest annual pace in 4 months. A significantly stronger than expected employment report not only calls into question the Fed's latest outsized rate decision in September, but the size of additional rate cuts needed going forward. Buoyed by fears of mounting weakness in the labor market, the committee opted for a, quote, strong start out of the gate. However, with the latest clear evidence of ongoing strength in labor market conditions, juxtaposed with still elevated and by some metrics accelerating price pressures, the Fed's efforts may be more appropriately focused on reinstating price stability. While, of course, one data point is never enough to sway the Fed in one direction or the other, with only a handful of key data points between now and the November 7th meeting, each is viewed with an increased level of importance. The September employment report surged past expectations, and the August PCE data showed a mixed bag of inflationary pressures, underscoring the need for a more tempered and patient approach to policy adjustments going forward, with a base case of 25 basis point cuts from here, along with a consideration, but not a commitment for further action at every subsequent meeting. As such, over the next 4.5 weeks, any further evidence of ongoing solid labor market conditions, coupled with still elevated prices, will greatly increase the probability of a smaller 25 basis point rate cut in November, or even allow the committee to take a pause and bypass next month's meeting altogether, meaning potentially no adjustment to policy in November, before turning to December, the final meeting of the year. Underscoring the ongoing dual concern of cooling labor market conditions and still elevated inflation, the latest commentary from Fed officials continues to muddy the waters in terms of expectations for future policy adjustments. Last Monday, for example, Federal Reserve Chairman Jerome Powell reiterated the lack of urgency in cutting rates. Speaking at an economics conference in Nashville, Powell said the Fed is in no rush to cut rates, given the stability and health of the U.S. economy. Meanwhile, Richmond Fed President Thomas Barkin emphasized the need for the Fed to remain focused on still elevated inflation, as there is, quote, still more work to do on prices. Noting price pressures have come down from a previous high, inflation, he said, remains still well above the committee's target. On the other hand, Chicago Fed President Austin Goolsbee continues to push for a more expedited pathway to neutral, suggesting the central bank must keep the unemployment rate from rising any further, no matter what. Aside from fears of a further slowdown in the labor market specifically, the latest read on the ISM underscored concerns of mounting weakness more broadly. In the latest read, U.S. factory activity remained in contractionary territory at a reading of 47.2 in September for the second consecutive month. The September read now marks the fifth consecutive read in contractionary territory, or a reading below 50. In the details of the report, prices paid fell nearly 6 points, back under a reading of 50 for the first time since December. Inventory slipped more than 6 points, and employment fell to 43.9, a 2-month low. On the stronger side, supplier deliveries climbed nearly 2 points to a reading of 52.2, while customer inventories and production rose to just about break even. New orders and backlog of orders both increased for the month, but remain in contractionary territory now since April of this year and October of 22, respectively. Of course, not all the data underscored concerns of waning economic momentum. Not all the data pointed in the direction of a weakening economy. The latest read from the ISM Services Index, for example, rose more than expected, gaining to a read of 54.9 in September, the highest since February of 23. In the details, business activity, prices paid, new orders, and supplier deliveries all increased, while employment, on the other hand, fell over 2 points to a reading of 48.1, the lowest in 3 months. Looking beyond the economic data of the day-to-day, two key events unfolded last week and continue to unfold, which could at least temporarily impact the pace and assessment of current conditions. U.S. dock workers, for example, opted to go on strike last week. The midnight deadline on Tuesday passed without a deal, resulting in thousands of dock workers walking off the job, the likes of which has not occurred since 1977. According to reports, nearly 2/3 of U.S. trade was set to be impacted, potentially affecting the delivery of everything from fruits to alcohol to auto parts and Christmas trees, with estimates suggesting the shutdown could cost around $4 billion per week. Thankfully, however, the strike was resolved relatively quickly, with dock workers agreeing to return to work after just 3 days. Also, Hurricane Helene battered sizable parts of the U.S. Southeast. The latest figures suggest the total damage and economic loss could be as high as $160 billion. That's a sharp increase from initial estimates that put it closer to $95 billion, and now potentially making it one of the country's costliest, certainly one of the top 5 costliest storms ever in terms of a market loss of property and, of course, life. The recovery, however, on the flip side, will likely offer a welcome boost to several months of activity as we head closer to the election. This week, the economic calendar begins today with a look at August consumer credit. Tomorrow, the NFIB Small Business Optimism Index for September, along with the U.S. trade balance, ahead of mortgage applications on Wednesday and wholesale inventories. On Thursday, we'll take a look at weekly jobless claims, along with a key report of the week, September CPI, followed by the PPI on Friday. Following a mixed report in July with the core CPI along with the headline and core PPI rising more than expected, the September report is expected to provide at least some further reprieve. The September CPI is expected to rise 0.1 and 2.3 over the past 12 months, potentially declining from a 2.5% annual pace in August. Meanwhile, the PPI is also expected to rise 0.1 in September and 1.6% year over year, potentially marking a minimal decline from a 1.7% annual rise the month prior. Excluding food and energy costs, the core CPI is expected to increase 0.2 and 3.2% year over year, potentially matching the gain in August, while the PPI is expected to rise 0.2 for the month and 2.7% on an annual basis, potentially rising from the 2.4% pace reported the month prior. Also on Friday, the preliminary October Consumer Confidence Index from the University of Michigan. And finally, continuing with a plethora of Fed speakers over the last couple of weeks, this week we will again hear from a number of Fed officials, including Minneapolis's Kashkari, Bostic from Atlanta, St. Louis's Mausoleum, and Mary Daly from San Francisco, among others. Also backing up to Wednesday, the FOMC meeting minutes from the September 18th meeting will be released, offering welcome insight as to the no doubt fruitful discussion over a 25 versus 50 basis point cut last month and the resulting dissent from Fed Governor Michelle Bowman. And with that, I'd like to thank you for starting your week with Stifel.